Bill Gross, if we look at the investment, the recent investment return in that, you mentioned the German trade, the spread trade with Germany. Did the central bankers get in your way? Are you willing to blame any sense of underperformance on Federal Reserve officials, ECB officials, et cetera, et cetera? These people didn't go by the book, and Bill Gross got run over because they did something new and original.
Well, not necessarily. I mean, they didn't go by the book, and it's up to the portfolio manager to analyze what that new book is in terms of reading. For 5, 6, 7, 8 years, quantitative easing has provided an opportunity for bond investors to take advantage of capital gains. The question became, in terms of Germany versus the United States, what would the effect of U.S. tightening by the Federal Reserve and the ultimate exclusion of quantitative easing in the beginning of quantitative tightening, what would that do relative to what was happening with the ECB? And the spread continued to widen and continues to widen even till today, and that's a very long-term situation.
But Bill, this is critical and critical going forward as you invest your own money, and everybody else wants to know what you feel about central banks that got away from Phillips curve theology over to balance sheet adjustment through quantitative easing, and then onto some set of quantitative tightenings to come. Which of those two was the real harm? Was it the balance sheet dynamics, or was it the death of the Phillips curve dynamic?
Well, I think it's basically both. In terms of the balance sheet, I find it very interesting, certainly in the U.S. with the Fed. The Fed expanded its balance sheet during quantitative easing from approximately $1 trillion to approximately $4 trillion. In a world in which credit in the United States was around $60 trillion. To my way of thinking, back in 2007 and 2008, the Fed was in a highly leveraged situation relative to total credit. It was 1 trillion versus 60 trillion, or 60 to 1. They expanded that and basically equitized their portfolio to 4 trillion, and that was a much leveraged situation. Now, quantitative tightening, reducing that to some extent, although probably going to stop in the next few quarters or so. It perhaps is at a point where the leverage inherent in the Fed's balance sheet and the leverage inherent in the U.S. credit economy is better, put it that way, although not necessarily satisfactory.
So many times I've found, Bill Gross, I don't want to mention names here, but a lot of acclaimed managers in whatever way are shown the door, and then X number of months afterwards, whatever their play was works out like a charm. Do you sense any kind of jump condition coming where yields come up or those spreads normalize? I mean, is it going to be smooth functions over 1 year, 2 years, 3 years, or do we get a jump condition and abruptness to some outcome this year, 2019?
Well, we need to speak to different central banks, I suppose, in different countries. In the U.S., the Fed is at 2.5% in terms of Fed funds. If you assume inflation's at 2, then you've got 0.5% in terms of real interest rates, which, to my way of thinking, is about as high as you can go in a levered type of economy. In the rest of the world, let's just take the ECB and take Japan as well. With their 0% interest rates, or even negative interest rates in Germany all the way out to 7 or 8 years, there's a very different situation, and things haven't really changed. And I wonder, versus the U.S., what that means for their economy. And as I've mentioned for many times on your program, Tom, the disadvantage, in addition to potential inflation down the road, the disadvantage of negative interest rates and low interest rates in the rest of the world is that savers are disadvantaged, and insurance companies and banks are disadvantaged, and so the savings function is at risk.
This is really important, folks. I'm going to do one more question on this and then switch themes in this generous conversation with Bill Gross this morning, again, on Bloomberg Television and Bloomberg Radio worldwide. We have negative interest rates. This was a huge theme at Davos in the hallways, Bill Gross, a chronic nature to negative interest rates in Europe. It redounds on the U.S. as well. Is that something that goes to a breaking point, or do you have an optimism that ECB in Europe as a political entity can extricate itself from these negative interest rates that don't help savers?
Well, I think it will take time to observe, and haven't we had that for the last 3, 4, or 5 years? And what we've found, certainly in the EZ in Europe with the ECB, is that these rates are just enough to keep growth above the line, and just enough, to keep inflation at 1 to 2%. Japan, for me, Tom, is the petri dish because they've been doing this for 10 or 15 years.
Right.
An economist would have predicted that if the government was buying up all of the debt issued by its Treasury, or if the central bank was buying it, that would be quite inflationary, but it hasn't been.
Right.
And so the quandary going forward is for other central banks, will this behavior create inflation? And in my context, will this disadvantage savers to the point where the savings function and the investment function is severely disrupted?
We welcome all of you on Bloomberg Television and Bloomberg Radio Worldwide. Bill Gross announcing his retirement today from Janus Henderson. We're thrilled to bring him to you on Bloomberg. Surveillance.